What is up, traders, and welcome back to Explain the Charts. Today is November 12th, 2025, and we are looking at one of the most interesting pairs on the board right now, the US dollar versus the Japanese yen, or USDJPY. As you can see from this daily chart, the price action has been incredibly strong, pushing up to 9-month highs. In this video, we're going to first break down the significant news and fundamental events driving this powerful move. Then, we will dive deep into the daily, hourly, and 15-minute charts to identify key levels and map out potential scenarios. Fundamentally, this rally is primarily a story of extreme Japanese yen weakness. The yen has been crashing, and a major reason is the recent appointment of Prime Minister Sanae Takaichi, who is viewed as being very pro-growth and is pushing for a massive new stimulus package to be announced by November 21st. This kind of government spending generally weakens a currency. Furthermore, this stance is seen as putting political pressure on the Bank of Japan to maintain its ultra-loose monetary policy, conflicting with their prior trajectory towards normalization. The BOJ's own recent summary of opinions showed a very divided board with no urgency to hike interest rates, pushing expectations for any tightening far out into 2026. This policy divergence is a huge factor. On the US dollar side of the equation, things are actually looking weaker. Recent labor market data has been soft, with ADP reports showing private sector job losses. This has increased market expectations for a Federal Reserve rate cut in December to around 70% probability. Normally, this would weaken the dollar, but the yen's weakness is so profound that it's completely overpowering it. This dynamic creates a very attractive environment for the carry trade, where investors borrow the low-yielding yen to buy the higher-yielding dollar, adding even more fuel to this uptrend. The biggest risk for bulls right now is the threat of intervention by Japanese authorities. As we approach the key 155 level, verbal warnings from officials have increased, signaling they are prepared to act if the yen's slide becomes too rapid. Alright, with that fundamental backdrop, let's see how this is all playing out on the daily chart. Looking at the bigger picture, we can see a dramatic recovery since the low point around the 140 level back in September of last year. The market has established a clear and powerful uptrend, characterized by a series of higher highs and higher lows. The surge really kicked into high gear in early October, which lines up perfectly with the news of PM Takaichi's appointment and her stimulus plans. On October 7th, we can see a massive bullish candle that took the price from around 150 straight through to 152 in a single day. After that powerful move, the market spent the rest of October consolidating and building energy for its next leg up. Let's zoom in on the action since that stimulus-driven surge began in early October. As we can see, after the explosive move on October 7th, the price based above 151, testing the 153 level multiple times. That 153 level acted as a significant resistance throughout late October. The real breakout occurred just last week on November 6th. We saw an enormous bullish candle that gapped up and ripped from the 151.40s all the way to 154.30, decisively breaking the October highs. This was a huge technical signal that bulls were firmly back in control. Since then, the price has been consolidating in a tight range, right underneath the major psychological resistance level of 155.00. This is the key battleground right now. Now let's switch to the hourly chart to get a closer look at the market structure during that consolidation period in late October. This view from October 23rd to October 28th clearly shows the battle around the 153.00 level. You can see multiple attempts to break higher being rejected, while pullbacks consistently found buyers and support around the 152.40 to 152.60 area. This coiling price action is exactly what builds the necessary energy for a major breakout, which is what we ultimately saw in November. It's a great example of how markets digest large moves before continuing the established trend. For the most recent action, let's drop down to the 15-minute chart. Here we can see the price action from the last few days. On November 10th, there was a steady grind higher from 153.80, culminating in a push above 154.20. Yesterday, November 11th, that momentum continued with another strong leg up that broke 154.50 and brought us to where we are now. Notice the pattern of sharp upward moves followed by tight, sideways consolidations. This is very characteristic of a healthy and strong uptrend. For intraday traders, the prior resistance around 154.50 now becomes the first level of potential support. Currently, the price is building a small base just under 154.70, potentially getting ready for another attempt at the highs. Okay, let's pull back to the daily chart to recap the key levels and formulate a plan going forward. The most important level to watch is the major resistance zone between 154.80 and the big psychological number at 155.00. This area also corresponds to a Fibonacci retracement level mentioned in the news reports, making it a very strong confluence of resistance. If the bulls can achieve a decisive daily close above 155.00, the path of least resistance is higher. Upside targets would then be 156.00, followed by 156.50 and potentially the 100% Fibonacci extension level near 157.70. On the downside, the first area of significant support is the recent breakout point and October high, around 153.12. A more critical support zone lies near 151.90, which has been defended by institutional players. A break below that level would signal a more serious correction could be underway, with the next major long-term support far below, near the 149.30 area. So, let's talk about potential scenarios. The bullish scenario remains the most likely, and I'd put the probability at around 70%. The fundamental story of monetary policy divergence is just too powerful to ignore. A clean break and close above 155.00 would reinforce this, likely triggering a fresh wave of buying. The main condition for this is that the Bank of Japan does not surprise the market with a sudden, aggressive intervention. A bearish scenario is less likely, perhaps a 20% chance. This would almost certainly be triggered by a direct intervention to sell dollars and buy yen, or if the Fed suddenly signals a much more aggressive rate-cutting cycle than anticipated. A failure to break 155 followed by a weekly close below 151.90 would be needed to invalidate the bullish structure. Finally, a short-term consolidation scenario has about a 10% chance, where the pair chops between 153 and 155, waiting for the next catalyst. Key things to watch for any comments from Japanese officials regarding the yen, upcoming speeches by FOMC members, and the details of Japan's stimulus package due on November 21st. The pressure is certainly building for a significant move. And finally, please remember that this is not financial advice. The analysis shared in this video is for educational and informational purposes only. Trading involves significant risk, and you should always conduct your own research and consult with a qualified financial professional before making any investment decisions. Thanks for watching Explain the Charts. Don't forget to like and subscribe, and we'll see you in the next one.